I think we're live. Hello and welcome to the xChange webinar from Tariffs to Trust, why verified container networks matter now. Welcome everybody who dialed in. I think we had more than 350 signups for this webinar, so this is a great indication that we ideally have a good turnout today. Very much looking forward to a good discussion here. While we wait for participants to drip in, to dial in, please see the poll that's going to pop up on your screen in a moment's time. I'm just going to ask you a couple of quick questions with regards to your experience and your personal view on this. Primarily, what do you personally see as biggest challenges for container logistics in 2025? Would love to have your view here as well, to take that into consideration also in this webinar. We are recording this webinar, which means that afterwards we'll be able to share this. We'll be able to share a transcript or summary, and of course we'll share all the notes that we're taking throughout this webinar, because we've set this up really as a workshop setting, and we'll take notes on a live whiteboard, including all of your inputs, all of your questions, in a very open discussion forum. The more open, the better. The more engaging, the better. I see participants still dripping in, so please, while we wait, take a moment to answer that poll. Throughout the webinar, you'll also be able to ask questions. There's a Q&A tab or a button somewhere on your screen. My screen looks a little bit different because we're hosting this, so I can't really tell you where exactly on the screen, but it is there, and you can ask your questions and drop comments. Feel free to do this as much as possible, because the more questions we have, the more engaging this is, the better for everybody. Wait another 10 seconds and then we'll get started, because I run out of things to say here. Cool, perfect. Then let's get started. Once again, welcome everybody, to all of you who have now registered and dialed in. I'm very excited to have you here. We haven't had an xChange webinar in quite some time. We used to run quite a few, once every month or so, and we said it's time to revive this tradition, and make sure that we do this again. We have with us Andrea, who is the CEO of Sogese. It's an Italian-based leasing company. I'm very excited to have him here because he has very good perspectives on, of course, container markets, but also global macroeconomic environments, specifically from a European and Southern European perspective.
Yeah, welcome to everyone. Happy to be here.
Awesome to have you. We also have Amanda. Amanda is CEO of Hyson Containers, so also a container leasing and trading company based in China. Amanda has great perspectives on the entire leasing and trading sort of market from a very Chinese or Asian viewpoint. So very much looking forward to your comments, thoughts, and perspectives here in this discussion forum.
Thank you for xChange for the chance to attend the meeting and open to face to so many people to discuss the questions. Thank you.
Fantastic. Fantastic to have you here. And then last but not least, we have Peter. Peter from Zeneta. He's Chief Economist at Zeneta. All of you most likely know the company, sort of the leading freight benchmarking provider, if I got this right. And Peter, of course, has not so much focus on container leasing and trading, but much more broader view on container freight rates in general. So very much looking forward to hearing your comments, thoughts, and views on what lies ahead in 2025. How will macroeconomic disruptions impact freight rates? What do we expect? What do you expect in terms of container markets?
Pleasure to be here. Thanks for having me.
Awesome. So then let's, what I'll do is I'll share my screen, and then ideally we have an sort of as open discussion as possible. Sometimes we might get stuck in a little corner, but that's the nature of live discussions. And to the entire audience, again, once more, please do get involved, share your questions, share your comments in the Q&A section. And then we'll take this up either live or towards the end when we enter a Q&A session. Let me now share my screen. All right, you should be able to see my screen. The introduction, we've already done this. Once more, what can you expect? So it's really, we want to have an open discussion here. We have some questions prepared on two segments. The first one is sort of what kind of challenges, risks do industry participants, and particularly container leasing and traders, but also on the freight rate side, expect in 2025. That's the first sort of 10-15 minutes I would expect of this discussion. And then we'll have a second part of the webinar really focused on mitigation strategies. What can companies do now? What role do verified sort of networks play? How to build up partnerships, how to build up resilient partnerships, how to find new partners to help you mitigate some of these risks. So that's going to be the second part of the webinar. And again, can't mention this often enough. Do engage and do use this as a live discussion forum. Last but not least, this is the last intro slide, I promise. We've just made the decision to open parts of our sort of formally closed leasing and trading network, open that for free for the entire world. You'll be able to sort of find new partners and start networking. You'll not be able to do transactions in the sense of what we started with at xChange. For that, you have to upgrade. We have to put you through a verification process to make sure that you're a trusted and reliable partner. But the first part of the network is now free, so feel free to check it out. It's very new, so very much looking forward to your feedback and comments on that. Cool. And now let's get started. I'd love to hope this is readable. Maybe as an inroad, and I saw there's also a question here from Francois around tariffs, right? So there's a lot of publicity on the tariffs at present. We see more and more comments are coming out of the US now also on sort of taxing shipping calls or calls from vessels that have been built in China. Quite a lot of discussions there, and now, of course, also on the other side of the Atlantic and the Pacific, there are talks about reciprocal tariffs and reactions. Would love to understand your views here, Andrea, Peter, Amanda. What impact does that have on your businesses, on containerized cargo?
Well, my point of view is very clear. I don't think that such policies are useful for the worldwide trade. They have never been useful in the past. I don't think they will be useful in the future. My thought is that this kind of policies will create, will destabilize the trade among countries. It will probably increase inflation for the final customers, for example, in the US, because I don't think that this kind of policies will have an immediate influence on the US GDP. So it will take some time for the US economy to adjust itself to this new setup. And meanwhile, the increase of duties and tariffs will just have a negative impact on the final consumer prices. On the worldwide trade, I think that this will turn into a lot of volatility. And volatility will create maybe some opportunities from some operators and some risk for others. I don't want to spend additional time on this issue because I want everyone else, all the guests, to share their ideas. But for example, in China and in Middle East, we noticed some changes, and especially those strategies that were carried on by local MBOCC will change in the very next future, and that will affect also the rerouting of cargo from China to Middle East and also on main routes, China, United States, and China, Europe.
And where did you see sort of new developments or new opportunities arise? Sorry, I missed this. Middle East and?
In Middle East, especially, between Southeast Asia, Middle East, and including, of course, the subcom, other words, India. Let's say that, MVOs are trying to focus. They know that this impact, the tariffs and the duties will, affect the trades. And now they are trying to focus themselves on market niche, where they were not present before. And in order to do that, they will establish new service. They will focus on customer care. They know that maybe these opportunities will be catched also by mainliners. And the problem will be basically to be able to obtain a slot on for their SOCs, but they also know that this kind of they will not be able to satisfy the full demand for slot, because the increase of containers around in that countries will eventually shift the preferences for mainliners for their own containers rather than using their SOCs. The problem will be, this will be, a new challenge for them, because MVOs will have an option, and the option will be to charter new vessels for the routes they want to ride based on the opportunity they notice. But chartering vessels, Christian, maybe better than me, it's a big risk. I mean, it's something that you can run if you have cargo stable on the routes you want to put the vessels in. But if volatility, as I was telling before, will affect the availability of cargo, then the amount of cost arising from chartering a vessel may completely wipe the profits arising from this opportunity. So that comes, again, the matter of, vetting and checking very well whoever you're giving the containers to for lease, but also for average, let's say, short operation, like one-way lease or short-term lease.
And Amanda, what's your view on this, especially from a Chinese perspective? What do you expect sort of the impact of these tariffs and potential trade wars to be on your business, on container leasing and trading?
Okay, I think because we are focused on container trade, so the container demand is under the cargo's the logistical demand. And now, because the China plus one and China plus X, so it is mean that China is also the main cargo supply in the world. Also, the containers demand in China is will continue. But from my idea, I think this is maybe to move to South Asia or South America. So from last year, we also focus on the market in South Asia and South America.
Why, if you don't mind me jumping in, why these routes? Why Southeast Asia? Why South America?
Because just we have some friends for they are the factory, the boss of the factory in China. And my hometown is also the industry center. Many my friends before they created the factory in China, now they have plan to set a new factory in South Asia. So I think the cargoes will from South Asia, and the demand of the logistics will move to some demand to South Asia. So this is why we just also focused on South Asia. And for South America, this is, I think this is not for my idea. This is just because the demand from South America, we have get the demand from South America. So we think this is a new land for us because just USA, they have so many compatibility. And for Europe, okay, so they have, for us, I think we kind of to do the more business such as the local company because they have so many local. We are a China company. This is not our, how to say, my advantage to do it. So we just we wanted to find some land we can get more business. Another side is that because last year we also discussed with xChange. xChange said the current from just the registers from South Asia and South America is become more and more. So it is mean the market may be warm in this market. So this is our idea. Because just so this is my idea.
And sort of, I think this is very, very interesting. Sort of, there's a lot of focus on sort of trade diversification, new trade routes, sort of niche players entering the market or expanding their market share. What still sort of looking at tariffs and trade wars, what's your expectation with regards to both container prices and freight rates? How will those be impacted by tariffs and other regulations?
Because now more and more companies become more and more professional in the container trade. So for my idea, I just think I wanted to be more better than our before and just to keep it run in the market. So I think this is the way for Hyzon to keep alive in the market. More professional, more faster feedback, and more source to our client. It is mean the value to our client.
Very good, very good. Peter, do you have any views on sort of freight rates, especially sort of with tariff implications, or do you say, you know, tariffs just make like Andrea's comment here, make the end consumer prices a little bit higher, sort of increase inflationary pressures, but you don't expect a lot of impact on freight rates. What's your view?
Yeah, I think Andrea started off with basically highlighting all the main economic implications here. Lowering our purchasing power, in particular in North America, is probably the one thing that will hit demand most severely, right? A little bit further down the road, but currently we have so many conversations with our customers at Sonetta because they are, of course, seeking insights to drive their business forward, right? They need to stand on a bit more firm ground than what they currently get from any political level, in particular in the White House, right? They are overwhelmed with uncertainty, and what they would like more than anything is a quiet business environment, a business environment where they can thrive, where they can build their business instead of trying to find, in quotation marks, smarter ways to get around the trade obstacles, right? So I think the currently the best advice is to keep your cool, be calm and collected, maintain your optionalities, because currently you cannot deliver one straight answer if the question raised keeps changing. I mean, we see this left, right, and center now. Tariffs against Mexico and Canada being raised and then taken down and potentially being raised again. How are you supposed to act if you are a business trying to just make a profit by embracing global trade, right? Yeah. So don't lock yourself into a corner. Don't make long-term decisions, right? And speaking of long-term decisions, everybody needs long-term decisions. So Christian, you also alluded to a bit of insights into to the trade lanes and where we see particular development on long-term freight rates and also the spot market trades, right? Because obviously one thing is that tariffs and any sort of obstacles to trade makes imports and exports more expensive. Sometimes it shows up in freight rates, sometimes it doesn't. More than anything, uncertainty is toxic to rates, and no two trades are alike. So it may be that that trade lanes impacted directly will see rates go up. It may be that trade lanes indirectly impacted, as we have seen with the most disrupted thing in the market right now, Red Sea. You see tons of trade lanes not directly affected, also having severe knock-on effects, right? So we see the same thing also for all the uncertainty coming out of North America right now. But in essence, we also see a fundamental development in the market that supply is on the rise, demand is on the decline. If we look at the Sonetta platform and we seek insights on long-term developments for trade lanes into the US East Coast and West Coast from China and Far East in general, we have seen a decline for the most recent 4 months now. So we're still massively elevated from a level seen pre-Red Sea, but we're seeing a clear tendency that shippers are and forwarders also signing with carriers are seeing a lower level, at least from the peak that we saw by the end of the third quarter last year. So there's something to take away in the fundamental development, while you need to struggle also to find out what will actually be the best thing for me going forward. And then just to sum up here, I mean, we saw actions taken from Trade War One back in 2018, 2019, right, where it was US against EU, US against China, right? We saw in particular Vietnam picking up on exports at that point in time, but the tendency seems to be more broad for Southeast Asia, as also alluded to by Amanda and Andrea and yourself, Christian, right? So exporters and global businesses need to find alternative sources in order to ensure that they can get what they need, right? And do they then lock themselves in to a contract with a carrier out of India for 5 years because they think India is the one best solution? Well, I think they should be careful, right? Because it may change tomorrow. This seems to be a game where the rules change way too often these days. And in a toxic business environment like this, I think keeping your options open and analyzing everything that you can, including the changes that we have seen starting on 1st February in the container shipping alliances. I'm not going on a rant on that, but it definitely also proves to be a curveball, but also an opportunity. for anyone in global shipping, right? Who is my preferred logistics service provider under given circumstances? Final thing, just since I have your attention here, you mentioned also the a proposal from the U.S. Trade Representative as of 24 Feb, right, where it seems to be that they are penalizing every carrier owning Chinese-built ships or operating Chinese-built ships or having them on order. I can tell you that it will hit across the board. Every top 6 carrier in the world have at least 20% of their operating active fleet right now built in China. And if you go into the order book, at least 40% of what they have on order is to be built in China, as the numbers stack up right now. So, so it's not a good day for globalization. It's not a good day for say free business competition, but it's one that where you more than ever need to assess your opportunities, yeah, and base it on the real insights. Go for facts, not fiction. Go for risk management, not for the casino. Back to you, Christian.
Thanks very much. That was a very, very broad sweep. Maybe let me drill down into one topic, because you mentioned sort of the Red Sea situation, and sort of demand is still elevated versus to what we saw before. The Red Sea it was essentially blocked for global liner shipping. How do you see that situation going forward? Because it's probably, you know, we had Breakback Middle East 2 weeks ago, and was probably the most defining discussion of the show. Hey, what will happen in the Red Sea, or by extension in Israel, will shape 2025, will shape the essentially effective supply picture. How much overcapacity on the vessel side or vessel and container side do we have in 2025 versus will we not have? So what's your view, and what do you hear in conversations with your customers?
Currently, we are 5 days away from what should be the phase 2 of the ceasefire between Israel and Hamas. We know that the negotiations are taking place, but in the current environment in the wider Middle East region, it seems to be a little bit shaky and risky, everything that surrounds the ceasefire. Having said that, it's been going well, at least for the first 5 weeks now. So let's see. We're not calling the end of the ceasefire as of now, but it's the one thing that have at least remove a little bit of the risk around the area in the Red Sea. And the Houthis have also been outspoken to the extent of where you can trust them or not, that they are not targeting international shipping, at least in the way that they used to do it early on in 2024. So some of that risk has been lowered, increasing, of course, the probability for global carriers to return to Red Sea transits. But I think that we're still some way between full return to the Red Sea. We're following the numbers of daily transits into the Red Sea from the southern end of Bab el-Mandeb, as well as from the north end in Suez Canal, right? And we do not see particularly uptick in container shipping transits as of now. They need absolute certainty before they are changing their global networks once again. Realizing also that right now, they are just spending at least 4 months changing their networks from their previous container alliances operations to the new ones, right? So some alliances like Ocean Alliance, perhaps also a little bit to the extent of MSC, may see fewer changes, but all other players in the global market see significant changes, right? So it's a massive disruption, and that's probably also the one thing that's a reason to see rates also being elevated, at least for the foreseeable future, and also most likely until we actually have a full return to Red Sea and a full implemented network of carrier services several months later. So I would say keep your is pretty focused on what happens around the second phase of the ceasefire that is supposed to start on Sunday. That will give you a clear indication whether the risk is going to be elevated for a continued rerouting, or we will see the chips lowered in that region for a faster return. But it's the one thing that more than anything delivers much higher freight rates, short-term and long-term in the market than any of the other geopolitical aspects, including US-led tariff wars.
Yeah, is if you like one question there at the breakback again was if we'll see a domino effect, sort of if one liner returns to the Red Sea for good, and I'm aware that this is not so easy for one single liner to do, especially if they're part of an alliance network. But is that also what you expect, that sort of if one carrier or one alliance returns to the Red Sea, then everybody else is pressured to do the same, and then we'll see sort of a sudden rush of overcapacity in the market, or what do you expect there?
Exactly like that. They are all eager to return, even though that profitability really rests on the rerouting currently. As soon as one carrier starts to deliver transit time, which is 2 weeks shorter than anyone else, and where there is a huge advantage to also connect Middle East, Indian subcontinent, other places in Southeast Asia to a much smarter way, in particularly on the backhaul. So European exporters in particular should embrace a return to Red Sea, because they are facing more severe obstacles also in selling their goods in the part of the world that seems to be omitted as carriers rush their capacity back to Far East, avoiding essential calls in Middle East and India to a large extent when compared to what they did before. But it will be a fast wave once they find out, okay, this is actually safe to return. But they need that assurance, and of course they also need to be aware that it's also lower insurance cost in the end. But even though they may seem to have a different risk assessment mechanism, depending on whether they are an Asian carrier or a European carrier, upon return, I think they will probably use something that looks like the same mechanism in order to assess, okay, are we safe to return? And then they will all rush back.
Yeah. Andrea, Amanda, any other risks that you take into consideration when you look at 2025? So we looked at sort of the uncertainty coming from particularly the US on trade policies, tariffs, etc. We looked at the Red Sea now a little bit, the situation in the Middle East. Are there any other factors where you say, hey, this is something to watch out for? That you take into
As far as me, well, we increased our exposure on Middle East and especially on the MVOCC market since quite long. So our experience is big enough to understand what's going on right now over there. And the problem is right now, if the Suez Canal matters will be lifted, we think that a huge amount of containers will be available over there. And that will affect both the ability of these MVOCCs to collect slots on the vessels owned by or chartered by mainliners. But also this will increase competitions, because we all know that the profitability of MVOCCs is based on the fact that their boxes are, going around and will not stay still in some container depots. By speaking to some majors, operators, MVOCC operators, mainly active in the Middle East, we understood that as far as their utilization rate was still, around or above 60%, everything is fine. Once the utilization rate drops below 60% or below 50%, then the cost of the of maintenance of these boxes will, you know, significantly increase, and that will put their own profitability at risk. So what I can say is that the changes arising from you know, the lifting of the problems in the Suez Canal, the volatility that's been going on over the increase of tariffs and duties imposed by the US, and policies of nearshoring, friendshoring, or reshoring of the provisions and cargo are trying to, they actually affect the strategy in the Middle East, and in particular the strategy put in place by MVOCCs. But I think that the major risk right here will be who shall I trust in this moment? And the response is you have to trust whoever has demonstrated in the past to be able to, you know, overcome the business cycles, the ups and downs of the business cycles.
Mm-hmm.
And in order to do that, of course, you have to do some checking, maybe a deeper checking than before, and make sure that these operators will have the situation under their own control. So do not only trust the financials, do not only trust the numbers and figures, but do trust the experience of the people leading the company and their ability to, you know, manage ups and downs of the business cycle.
Mm-hmm.
My idea is that the increased pressure and the competition in that area will certainly affect the survival of some smaller MVOCCs. So what I expect in the next 1 or 2 years is that weaker operators will be probably kicked out of the market, while only structured ones and maybe bigger ones or more capable ones will be able to survive and compete in their own market niches, but successfully.
Mm-hmm. Mm-hmm. Amanda, is that also something that you see sort of on the China-related trade? Because this was very much focused on the Middle East and the ISC region. Is this also something that you see that you sort of take into consideration in your business decisions?
Well, as far as China, you know, I don't think that duties and the increase over the tariffs will affect enormously, hugely, the amount of cargo arising from China, because as probably Peter was trying to explain, operators are trying to find alternative and solutions, and China will still be, you know, a reference point for spare parts for some types of cargo. Maybe it will not be addressed directly to the point of destination, but it will be rerouted to somewhere else in the Southeast or in Middle East or in Mexico or in Latin countries. And he will reach destination through, you know, alternative options. But you know, I don't think that all these changes in the foreign trade policies imposed by the United States will, at least in the short term, affect the amount of cargo, the amount of trade arising from China itself.
Mm-hmm.
It will just be conveyed differently, but somehow through alternatives, it will reach the final destination, maybe at a higher cost for the freight forwarding, for the freight forwarding company, and so for the final customers itself.
Amanda, I would love to hear your perspective, sort of from a China vantage point, so to speak. What do you think about this? Is there so the question is so we started discussing, of course, the situation in the Red Sea, and Andrea was outlining how this will likely, if the Red Sea opens up again, this will likely put significant pressure on NVOCC operators in the region, because the mainlanders will return to the region, their capacity, the NVOCC capacity utilization will drop. And my question was, if this is sort of relevant in Middle East ISC, is this also something that you would expect in China? I don't know, that there's an influx of capacity, suddenly container supply goes up. What do you believe the impact will be on China-related trade, but also China businesses, be it container traders, be it NVOCC operators, etc.? Or what do you believe will be the impact on your business if the Red Sea opens again? I think we have some difficulties.
Let's see.
I think we have some difficulties sort of on the connection, but that's fine. We'll just revert to that later. There was one question here in the audience, because we talked a lot about Middle East IC region as well as sort of China-US trade. But there was one question here is, what impact would tariffs have on the EU trade? Do you think there's any changes on the China-Europe route? Andrea, you already outlined that sort of on the backhaul cargo, sort of operators will benefit from returning to the Red Sea because the connection is much shorter, of course. But what are other implications that we can expect?
Well, this is a smart question, and it's very much related to the possibility that the war in Ukraine will end. As far as I know, many Chinese traders are preparing themselves to convey cargo and containers through railways from factories to mainland in China, and from internal mainland in China to the Eastern Europe and then to EU. So there are a lot of opportunity arising from the shipment of cargo through alternative routes, and in this case, through railways. Some of our customers have arranged new logistics options and operation to make sure that the flow of containers will reach Eastern Europe in an effective way. And I think that this will be a winning strategy, not only to overcome the problems arising in the Middle East and the increasing competition on sea routes, but also to assist potential demand of goods and containers if the reconstruction of the Ukraine will take place.
Peter, would love to hear your view on sort of freight rates. What's your assessment? What's your expectation specifically for China, Europe? What are the factors impacting this, and how do you see 2025 shape up, so to speak?
Yeah, I think it's a real good question being posed also in the chat. I already gave a few responses in the webinar chat as well, but I see the knock-on effects from a trade war on tariffs in the North Atlantic basin between US and Europe, having very little effect on China to Europe, mainly because the fact that the products being shipped are quite different from one another. So in terms of a sort of substitution, in terms of taking goods that may be no longer competitively coming from North America or the other way around, I don't see that change in commodities at least. But from a demand perspective, I think we should expect China to Europe. I would say once again to surprise on the upside a little bit. We have the German economy really struggling these days. It used to be the locomotive of Europe, but if we reflect on 2024. And the most recent month where we got data, reliable data on in terms of imports, we saw record high imports from Far East into Europe, North Europe, in December. Right, so there seems to be some sort of disconnection between the underlying economics and imports, right? And to me, getting back to what are my options as a shipper and as a manufacturer, ranging from whether you're a pharmaceutical company or an automotive business, right? One thing that you can do, which is still the most cost-efficient way, is to bring in goods faster than you would otherwise do. We call that front loading, as always. And the more expensive options are bring your facilities to a different place, right? Bring your manufacturing to somewhere else, find sources somewhere else. But it's always so much easier said than done, because you don't just relocate a manufacturing facility just like that. There is also tons of raw materials that goes into that. And we must also say that even though we have been talking about China plus one, China plus X for a number of years, literally, it also proves the point that it is super difficult really to untangle. And I don't think it's in the interest of anyone to 100% untangle from China, which is impossible. Let's face it. The infrastructure set up in China is second to none. So every time we do a move and see a move away to diversify our sources, there's a price tag that in the end will lift the cost base for not only logistics, but also for the products produced, until we see a massive scale and a massive alternative elsewhere. We know that the Indian government have made it clear that they finally, it seems to be, seek also to engage in megaports being built for exports of Indian products, or at least products produced in India for foreign markets. India have not really surprised overwhelmingly in the most recent decades, even though they had built in India for a number of years. But it seems to be that the balance, the checks and balances of global geopolitics seems to favor India more going forward than ever before. They have been lying low for a number of years, and now it could be the go-to place, even for American companies, as we have seen with Apple in the most recent years. More keen interest in India, and well, getting back to one of my main points is that it's super tricky to actually nail what is the right solution to the current problems when you do not know what are the current problems, right? Because also reflecting a bit on the effects from trade war one, we have seen, if we compare volumes going from China into US, up by 10% when you compare 2024 to 2019, right? But if we see the same trade lanes from China into Canada and Mexico, they are up by 60 and 70%, because American importers thought that investing in friends like friendshoring or nearshoring was the right thing to do. Now, only 6, 7, 8 years later, it proves the point that it may not be such a good solution in the end, apparently, since the rules of the games have changed. So it's really a toxic environment right now, and we can only hope for any say meaningful clarity to come about as the year progresses. But currently, friendshoring was a good idea, but not the full solution. So Yeah, we're in for an interesting ride in 2025 on all parameters, Christian, for sure.
Yeah, makes for an interesting year. Makes for an interesting year, that's for sure. And a little bit conscious of time. Sorry, I think we got carried away a little bit in the discussion of all the risks and all the uncertainties on the horizon. Would love to maybe discuss one thing in particular, and that's probably on top of mind of a lot of people who have dialed in as well. Is what can businesses do? What can companies like Andreas's, like Amanda's company, what can they do to prepare for this year to be optimally set up, so to speak? We already talked a little bit about building up stronger partner networks, having to dig a little bit deeper into evaluating potential partners, not just the financial performance, that was Andreas's point, but also really looking at the people running the business. What else is there? What else can companies do to set themselves up for a good 2025, no matter sort of which way the pendulum might swing?
Well, my opinion is that we need to avoid long-term commitments. As far as our company, we do not engage in new ventures and new customers unless it is valuable, unless we can assess the risk arising from this operation is can be managed in a normal way. So we will avoid over excessive risk. And also another point is to make sure that the inventory will not exceed. Because in a volatile market, in a volatile situation where container prices may, let's say, go up and down in very short period of time, then also, the issue of building up speculative inventory becomes a matter to manage. So my business view is, okay, let's catch the opportunities. Let's make sure we will deal only with reliable customers, or at least with those customers that proved to be reliable in the past years, and do not commit yourself to long-term contracts, and make sure your business model will remain more flexible than before.
Okay.
Amanda, can you? Yeah, go ahead.
Yeah, so just because for in 2024, the market I think become worse, and some current is payment is also become worse. So in the next year, we will focus on the certainly profit, such as the especially for the certainly business. So we will. Also, just we will improve the market research, and also we will correct the stricter partner selection process. It is mean we will just choose and find more and more supplier and current. So also we will optimize our internal process to make our team more effective, and also make everything more faster and more detailed. So and I think because for the company, we can't control the world, we can't control the world change, but for inside, if the market is not good, we will focus on the inside grow up. We will focus on our team, focus on our systems, focus on the train, focus on more and more, make our teams better, everything.
And when you say sort of both you, Amanda, as well as Andrea, you mentioned sort of that you only focus on sort of reliable partners, you want to increase your efforts in vetting them and making sure that they are and remain reliable. What tools do you use? How do you do that effectively? How do you look at that?
Well, our company strategies has always been to find the right partner based on the impression that we have over the people leading the company. So we do not weigh too much figures and numbers, but we focused on experience of the management team, ideas, strategy. For example, when they ask for a container lease, we want to know where these containers will be conveyed, why, what is the project underlying, the choice, if they have an expansion plan, how they actually control their fleet and their profitability. You know, there is customers of mine saying that they change their control system based on a weekly check of their profit and loss. So, you know, this kind of attitude toward the control of the business really, you know, communicates a lot of value for us, because that means that the management is always ready to check tools that will, you know, allow them to change whatever strategy they put in place previously. So this is also, you know, a form of flexibility that I was talking about. Differently, if you get involved in a company that has no control over the fleet, no control over the accounts, or only a basic control over the P&L, because they only check it after, you know, 6 months or once yearly. Well, you know better than me that if you don't have control over that, you know, don't have control over your cash flows. And most of the companies right now died recently because they cannot cope with their, you know, financial obligations. So that is a point that we really value in the choice of whatever partner we should engage with. And I think that these strategies proved to be successful, especially in the last few years, where, you know, the ability of the management to overcome problems is even more important than the dimension of the company or the wonderful figures they show in their balance sheets.
Yeah. And so this was sort of on sort of performance, business performance, etc. Is there anything you do on sanction compliance? I don't know. How do you make sure that your partners, your lessees in this case, or your trading partners, don't suddenly end up on a sanction list? Or how do you keep check on this?
Well, we use some business intelligence, so we engage in some companies that will do some research on our behalf, and we do that regularly. And I always say, and also these companies will also check for payment performances. They will ask for, you know, confirmation from our, you know, potential customers, partners. So there are you know, a lot of sources through the business intelligence that we can use to assess whether a company is good or not. What really matters right now is the qualitative factors. So the fact that the reputation on the market is high, the payment performances have not failed, and the experience of the management team is based on a long-term presence on the market and will not change that much. Also, another point that we learn to consider is the ownership structure. Sometimes we got engaged in companies with the ownership structures is based on a lot of investors. You know, it's hard for me to cope with 2 people, so I don't know how they can, you know, manage, you know, decision when the ownership structure is based on 5, 6, even 10 investors. They have, you know, different views on the market and different targets. You know, it is good if they are, you know, focused on long-term results, but some of them may be focused only on short-term profits and the collection of their, returns. So that is something that really matters in our decision whether to engage in a new lead or not. But those are, factors and points that were kind of neglected in the past, and right now I think they need to be considered properly.
Yeah, yeah. I'm a little bit conscious of time, but this is an assist sort of that I cannot go unused, because this is exactly why we decided to open up our xChange network, right? We saw that a lot of our customers were more and more interested to understand the background of their partners, right? Not just their financial performance and how well they pay, but also, like you said, what's their ownership structure? What's the operational performance? How quickly do they, I don't know, pick up a box, return a box? How often do they have damages? How quickly are disputes resolved? So all of the things that sort of make a good company work, of course, are now more and more in focus because of these essentially uncertain times. And you really want to have a good view into who you're dealing with at any point in time. And that's why we opened up that network. We also, like you said, we also leverage third-party intelligence tools to sort of supplement our customers' profiles, and then ideally we hope that we can also assist you in building up your networks and keeping a close eye on your partners' performance.
And let me tell you this, the views on the future strategies is important, because I noticed that some partners or some clients will just need to want to reach the success or the result of some competitors, but the strategy should not be driven by this kind of factors. The strategies must be led on results and factual targets. So again, also xChange is a source of qualitative information through ratings, through the discussion that I may have with my account manager. But the point of all of this is that, okay, it is really useful to look at the financial figures. Yes, it is, but it's a small part of the due diligence you have to carry on to better understand who you're dealing with, especially if you don't have a history of success with your potential partner.
Perfect. I think that's a very, very good wrap up of this webinar. In uncertain times, make sure that you remain flexible as a business, increase internal operational performance. Like you said, Amanda, you cannot always control the external world, but you can certainly control what happens within your organization. So focus on that, and then make sure that you really have a close eye on which partners you're dealing with, what their performance is, and also what their strategies are going forward. Now, I would love to keep this discussion going. I think it's very, very interesting, but unfortunately, we ran out of time. Thanks a lot for participating, everybody who joined and asked questions. And of course, special thanks to our panelists, our workshop discussion partners here, Andrea, Peter, Amanda. Thank you so much for your time, your views, your comments. Much appreciated. And of course, we'll share this recording. We'll share also the notes as a post read, so to speak, to everybody who dialed in and everybody who registered but couldn't make it. Thanks a lot.
Thank you.
Thank you. Take care.
Bye bye. Bye bye.
Take care. Bye bye.